Good morning, everyone, and welcome to Chapter 4, Episode 3. I mentioned at the beginning of Chapter 4 that now that we are selling a product, it opens up a whole new can of worms, and we have several issues to address. So that's why there's several videos in this Chapter 4 series. So this is the third of 4. There'll be one more after this one. So let me get my picture out of the way. And first, let me remind you what we've already talked about. We've discussed that the inventory account, which is an asset on the balance sheet, the inventory account is where we will keep up with the product that we are buying to sell to customers. When we make a sale to customers, we have to record two things. We have to record the sale. In other words, how much we are getting from the customer. But we also have to record the fact that we no longer have this product. So in the journal here in the blue, this is the entry we would record at the sales price, debit cash, or debit accounts receivable if they haven't paid us yet, and credit our sales revenue. And so now I don't have numbers in it, but you can see where that goes in the ledger. And then we would also record the fact that we no longer have this product. So in the pink journal entry, you can see that I'm crediting inventory and debiting cost of goods sold. So here that is represented. Remember that cost of goods sold is an expense account. It typically is the very first expense listed on the income statement because number one, it's going to be the largest expense. When you're selling a product, your major expense is usually the cost of the product, what you had to pay for it. All of this information that is passing through the inventory account, we summarize with this calculation here. So ignore the part of the orange just for a minute. And so this is the calculation that we have looked at in the past. Beginning inventory plus the cost of your purchases. That's what was in the inventory account. That tells us the goods available for sale. So the goods available, that's the total amount that we had available for sale to the customers. When all is said and done, that total is either still here, that would be our ending inventory, or it's gone out the door. And so whatever's gone out the door would be included. The cost of that would be included in this number that's credited to inventory and debited to cost of goods sold. Now you may be thinking, well, what if somebody stole some of it? We're going to talk about that in the next video. But for right now, let's just assume it all went out the door with a paying customer. So in this video, I'm just going to talk about a couple of items that are adjustments to the cost of your purchases. When you purchase inventory from a vendor, and typically this is going to be an ongoing relationship because it's a supplier of your product line, and so you're going to be making periodic purchases from them, and as part of that you're going to be negotiating who has to pay the freight, and so we're going to talk about that. And you'll also be, once you've purchased this, the vendor would like you to pay them as quickly as possible. And they may give you an inducement to do so by offering a discount if you pay early. So if you pay early and take advantage of a discount, we call that a purchase discount, and that would reduce the cost of your purchases. If you had to pay freight on that incoming product, then of course that would add to your cost of purchases. So this adjusted cost of purchases would go into this calculation of cost of goods sold. So those are the two things we're going to talk about in this video. Let's talk about purchase discounts first. Suppose you negotiated with your vendor for this product, and they gave you these terms, 210 net 30. What that means is they would like you to pay early, they'd like you to pay quickly, and they will give you a 2% discount if you pay within 10 days. 2% if paid within 10 days. But the whole thing, anything you don't pay early is due in 30 days. This is not a fraction. That does not mean 2/10. It means you get a 2% discount if you pay within 10 days. Another example might be 115 net 60, or 115 net 45, or 315, or whatever. But like this would mean a 1% discount if you pay in 15 days, but the whole thing is due in 60 days. So there could be any, whatever the discounts are that they offer. So here's how we would deal with that. First of all, let's talk about how much the discount would be. Suppose we purchase $40,000 of inventory with the terms 210 net 30. As long as we pay within 10 days, we get to knock off 2%. 2% would be $800, and so we would end up only having to pay $39.2. So here's how this would go into the accounting records. When we make that purchase, we would debit inventory for $40,000. I'll take that to the ledger. And credit accounts payable. Now we know it was purchased on account because they're giving us terms to try to encourage us to pay early. If we pay cash, they wouldn't be doing that, of course. If we pay within 10 days, then we're only going to have to pay $39.2. So we're going to write a check to the vendor for $39.2 credit cash. Think about this. After making that $39,200 payment, how much do we still owe them? Well, nothing. That's the whole point of a discounted payment. So we're going to eliminate that entire $40,000 accounts payable. And to make the journal entry balance, the discount, we're going to credit that to the inventory. And when you do that, that reduces the cost of the inventory down to $39,200. So now the adjusted cost of the inventory matches what we actually ended up having to pay for it. So usually we would credit inventory when product is leaving, but in this case, we're just adjusting that $40,000 debit. So again, purchase discounts reduce the cost of those purchases. Okay, we'll come back and look at a more comprehensive example in a minute, but now let's talk about freight charges. Suppose we are this company in Abilene, and we buy product from a seller somewhere. That's the seller over here to the left. Let's say that's Lubbock. And we're going to sell it to a buyer, and maybe that buyer is over in Dallas. Okay? So regardless of how much the product costs and so forth, in addition to paying for the product, we also have to agree who's going to pay the freight. So let's say we're going to get a trucking company to make these deliveries. So here we are negotiating with the seller about who's going to pay the freight, and then over here we're going to be negotiating with the buyer. On the invoice, whoever has to pay the freight, or the shipping terms, are indicated with the terms free on board, abbreviated FOB. So if the invoice says it is FOB seller, that means it is free on board to the seller, which means the buyer would be paying the freight. So if we were negotiating with this seller and the shipping terms were FOB seller, that means it's free on board to the seller. That means we, the buyer, would be paying the freight. Now when we're paying freight on purchases, that is incoming product. So we would call that freight on incoming product. And just remember that if you have to pay freight in, when you're buying product, freight in, IN, is debited to the inventory account. In other words, the cost of that inventory is simply increased by the cost of that freight. And that makes sense. So again, up here in the pink, we would, if it's FOB seller, the buyer pays the freight, and the freight in would be debited to the inventory account. So this payment here is like when we're writing a check to the trucking company, and so the debit would go to inventory. On the other hand, when you're selling your product, when you're shipping it out, now you're negotiating with the buyer about who's going to pay the freight. And we might just, if we sell it to them, FOB seller, in this case, we're the seller, so we won't pay that freight. But if we negotiate free on board to the buyer, FOB buyer, that means the seller pays the freight. Well, in this second transaction, we are the seller, and we would pay that freight. Freight on outgoing product is debited to a new account called freight out expense. It's a separate expense of selling the product. So here's the journal entry: write a check to the trucking company and debit freight out expense. So remember, when you're negotiating, you may not always be paying the freight. So for example, on this one, the reason we're paying the freight is because the terms were FOB seller. If it was FOB buyer, we're the buyer on this side. So if it was FOB buyer, we wouldn't have any freight to pay. But on incoming product, if we do negotiate FOB seller, we're the buyer, we pay the freight, and freight in, IN, goes to inventory, IN, inventory, okay? Over here, we are the seller, and if we negotiated a FOB seller, we wouldn't pay any freight. But if it's FOB buyer, free on board to the buyer, we would pay that freight, and freight on outgoing product is debited to an expense account called freight out expense. Another key important thing to remember: whoever is in contract with the trucking company owns title to the merchandise. So if you're paying the freight, that means that while it's on the truck, it belongs to you. And that makes sense. So over here, if it's free on board seller, which means we are paying the freight, we're the buyer, that means as soon as it goes on the truck, then that becomes ours. So that has to do with liability. Who owns it while it's on the truck? You know, the trucking company never takes title to the merchandise. They're just providing a service. So we have to agree, okay, who's going to be responsible for it while it's on the truck, you know, if something happened to it. And if we agree to FOB seller, we take title when it gets put on the truck. On the other hand, over here, if we negotiated FOB buyer, it's free on board to the buyer, we are paying the freight, so that means we still own the merchandise until it gets taken off the truck. So you have to be thinking about, okay, which direction is it going, and who's paying the freight. Okay, let's look at a couple of examples like that. So here is the kind of a replication of what we had just seen. Look at transaction 1. It says your company in Abilene purchases $10,000 of product from a seller in Lubbock. Terms 210 net 30 FOB Lubbock. And the trucking company is going to charge $150. Okay, for $10,000, we're going to debit inventory. Debit inventory, credit accounts payable, $10,000. So I'll go ahead and here's our ledger. Debit inventory, and I've got the liabilities down here. So this is the balance sheet information. Here's the income statement information. So credit accounts payable. And let's see, this is the trucking company's charging $150. Now, if this is FOB Lubbock, that means the company in Lubbock, it's free to them in terms of the freight, so we're paying the freight. This is freight on incoming product. So we're going to debit, when we pay the trucking company, we're going to debit the cost of that freight to the inventory account, 150. So credit cash, debit, inventory for 150. So now the total cost, well, let's take care of the discount too. We're given terms of 210 net 30. If we pay within 10 days, we get to knock 2% off. 2% is $200. So we're going to pay $9,800. So here we are making the payment. Credit cash, $9,800. That would go to the cash account. Debit the accounts payable for $10,000. Remember, that takes care of the entire liability. And the discount reduces the cost of the product, and so we'll credit inventory for that purchase discount. So now, in our inventory account, we have a balance of that $10,000 plus the freight in and minus that purchase discount. So the balance here is $99.50. So if you want to think about that in real practical terms, suppose we had purchased 1,000 items. So originally, we were buying them at $10 a piece. 1,000 items at $10 a piece is $10,000. But now the adjusted cost per unit is $9.95 after taking into account the purchase discount and the freight. Transaction 2. Our company sells the inventory. So let's just assume we sell all of it to a buyer in Dallas for $15,000. Terms FOB Dallas, and the trucking company charges $200. Remember, when you sell your product, there are two things to record: the sale and the cost of the sale. Let me move this up just a little bit. The sale was for $15,000, so debit accounts receivable and credit sales. I just don't have the accounts receivable on here right now. The credit sales. Also record the fact that you no longer have this product, so we're crediting inventory, $99.50, and debiting cost of goods sold. And then also, since we have to pay the freight, we're going to write a check to the trucking company, credit cash, and this is freight on outgoing product, so we'll just debit freight out expense for that. So that's kind of putting all of them together. Notice this too, that freight out is an expense. Well, freight in, remember, went to the cost of the product. Anything included in the cost of the product will sit in the inventory account until we sell it. And then when we sell the product, that entire cost goes to cost of goods sold. So all of it eventually gets to an expense account. Remember, cost of goods sold is an expense. It's just a question of, does it go to expense right away, as in freight out, or does it first go to the asset account and then get expensed when we get rid of that inventory? And that's, so freight in is included in the cost of goods sold. That really puts everything together, and that in essence is what I wanted to cover in this video. But I've got one more example. Let's just do another quick example together. We purchased $30,000 of inventory from a company in Chicago, 210 net 30, FOB Chicago. Debit inventory, credit accounts payable. Now I'll post that to the ledger. Inventory account, accounts payable, down here. So we're in Abilene. Having a hard time finding a place to put my picture. Okay, who pays the freight charges on this? It's coming from Chicago to Abilene. We negotiated free on board Chicago. That means it's free to them. We have to pay the freight. So we're going to write a check, $500 to the trucking company. This is freight on incoming product, freight in. So that would go to the inventory account, debit inventory for $500, credit cash. And we also paid within the discount period. The discount period was 10 days. We had a 2% discount. 2% of $30,000 is $600, so we're going to pay $29,400. Write a check to the vendor for $29,400. That eliminates the entire $30,000 liability, and the $600 discount is offset against the cost of the product. And so now the net cost of all of this is the original cost plus the freight in minus those purchase discounts, so $29,900. And then, so again, suppose we had bought 1,000 items. Originally the cost was $30 a piece. Now the adjusted cost is $29.90 a piece. So that would be, we would need to know that if we just sold one item or two items or whatever. But suppose we sold all of it to a company in Nashville for $40,000. Two things to record. The sale, this was a $40,000 sale. Credit sales, $40,000. Debit cash or accounts receivable if they haven't paid us. And also record the fact that you no longer have this product. So credit inventory, debit cost of goods sold. $29,900 credit to inventory, debit to cost of goods sold. And if this was shipped FOB Nashville, again, here we are talking about this truck going to Nashville. And if it was shipped FOB Nashville, it's free to the Nashville company. We're paying that freight. That's outgoing product, so that would be debited to freight out expense. Credit cash and debit that expense. Okay? So, these are the journal entries. We post to the ledger. And suppose when we're making the financial statements, I've got that summarized over here. So let me show you this. First of all, the calculation of cost of goods sold. Remember, we've gone through this calculation, beginning inventory plus purchases. Well, the purchases that we're going to add is the adjusted cost of purchases. Okay? So, just to help you see that, let's put that in orange. And so the adjusted cost of purchases, which is that $29,900, that's added to the beginning inventory, which was 0. And so our goods available is $29,900. We don't have any ending inventory either. We just tried to keep this focused on these purchase adjustments. So the cost of goods sold is $29,900. We can see that in the account. And that $29,900 is now subtracted from sales. We get a gross profit. And for these two numbers here, that's what goes into the calculation of gross profit, sales minus the $29,900. We have gross profit of $10,100, and then down below the gross profit is where we would subtract out all of the other expenses that have been incurred. In this example, it's just the one, freight out. So that gets us down to net income. So that's a summary of how all that works. Let me talk about one other thing. Remember when we were making this purchase, and if you'll recall, we were paying the freight on this item. because it was free on board to the Chicago company. They put it on the truck for free. So when did title pass? Well, as soon as we're the ones paying the freight, so we are in contract with the trucking company, that freight is ours while it's on the truck. That means the title changes as soon as it got put on the truck. So what happens if something happens on the way to Abilene? What if they have a wreck and everything burns up and it's destroyed? So those kind of things happen. So then the question is, who owes who? Who takes the loss? Who's responsible to who? Well, as far as the trucking company is concerned, they're expecting payment from us because that became ours when it got put on the truck. Now, hopefully, we are insured and we can look to our insurance company and even the trucking company and hold them responsible because of the service that they were providing. But you get into a question of who owes who, and you'll talk more specifically about that while it's when you're in business law. So the key issue is who owns it, who is liable to who, and we want to reflect that in the financial statements. So that is episode 2, adjustments to the cost of purchases. Work with that and just think about this simple flow through the inventory account over to cost of goods sold.